And Savita, lots changed since January 1st, as you point out, as some of the reasons. I wonder if this is the last trim that you'll be doing. You went from 4,600 on the S&P to 4,500. No one was expecting necessarily World War III, COVID resurgence, a more hawkish Fed. There's a lot of reasons. How much confidence do you have in 4,500 for a year-end target at this point? You got one foot out of the door on that number, too?
Well, I would have to say that it depends, obviously, on the outcome around geopolitics. I mean, we're assuming that we don't see this sort of full-fledged nuclear kind of engagement. And in that scenario, I think asset allocation would be the last thing on our minds. But assuming that we get through this geopolitical skirmish, our view is that at this point, the probability of a recession that's priced into the market is about 1 out of 3. And if that probability increases, we would be likely to lower our target. But I think that regardless of, recession likelihood or recession risk, it's time to get a little bit more defensive. We're seeing a lot of changes in terms of spending patterns, in terms of just sort of consumer sentiment. I mean, I think the one biggest change that we've seen is that spend on big ticket items has tapered off, and we've seen consumers uptick spending on services. So removing geopolitics and recession risk from the scenario, if you just think about the consumer has actually meaningfully shifted, which means that you don't necessarily want to buy materials and consumer discretionary and goods purveyors. You really want to shift towards services. I think what that means is you don't want to be long materials, you don't want to be long consumer discretionary, and you really want to be overweight some of the more service-oriented beneficiaries like energy. I think as we all move out of our homes and start traveling again, assuming that's a viable option this summer, that should continue to benefit oil. Geopolitics is always a strong beneficiary for oil prices. I think on the overall market, that's the area where I have the lowest conviction. I think that, today represents an investment opportunity for the next several years at a sector level. But on the overall market, I think we're past the point of just simply buying the index and generating great gains. I think we're in much more of a stock picker or a sector picker's market, and total return is the name of the game from here. That's why we would be focused on sectors where we see a really strong likelihood of dividend growth, dividend yield. It's been one of the best ways to invest this year, and we think that's going to be the case going forward.